Hi, everybody. Jeff Yastine here, and welcome back to another edition of Market Insight. And I'm joined by my friend and colleague, Mike Carr, editor of Precision Profits and Weekly Options Alert. Mike, welcome.
Thank you, Jeff.
You know, in recent days, we saw the Federal Reserve lower interest rates yet again, by a quarter point, the third time this year. There seems to be some debate as to whether or not that's going to help the stock market or not. What's your opinion on it?
I think the Fed is doing all they can to boost stock prices. They're really trying to keep this bull market alive, and they're actually trying to keep the economy alive. GDP came out in the recent days as well, showed growth is back under 2%. So the Fed's worried. They're going to do all they can to keep the economy and the stock market trending higher in the next year.
Now everything you've said, in some ways, you could say, well, that's old news. It's been out there for a while as far as the economy slowing, and we're facing these trade tensions with China and with Europe, and there's concerns about the valuation levels of the S&P 500, et cetera, et cetera. So in your view, then, what does the Fed, having now lowered interest rates for the third time, how would that then help stocks? Will it help stocks is my direct question to you.
It will. It's making money incredibly cheap. And there's two ways to look at GDP. There's the headline way, 1.9%. And so that's real after inflation. There's also considering inflation. And because inflation is so low, GDP, the nominal rate is closer to 3% now. The Fed panics when that drops under 3%. And that's what the Fed is looking at. So they're trying to find a way to let inflation take hold finally.
Yeah, and that's my view as well here. I feel like a lot of the discussions about slowdown, and you've referenced the GDP report coming in at 2.9%. And I feel like a lot of that has sort of been pretty well discounted here. And I think the only thing the market perhaps has not discounted is somehow the chance that the economy is truly decelerating into a recession, but I don't really think the data supports that yet. So I can only conclude that with the Fed having cut rates now for 3 times this year, and we are heading into what, at least historically and seasonally, is a strong period of the year, that the odds say that the market will move higher, and perhaps despite a lot of the negative headlines and concerns that we all have here.
Yeah, Jeff, you've been around a long time, so you've heard all of the old sayings like the bull market climbs a wall of worry, and there's certainly a lot to worry about. That wall is high. Historically, after the Fed cuts rates 3 times like this, stock prices are higher 20% over the next 12 months on average. Could be pullbacks along the way, but earnings are coming in. 80% of companies are beating earnings expectations. That's bullish. It's really hard to find the catalyst for this bear market that everyone's so worried about.
I agree. I told my subscribers in a message last Sunday, to my paid subscribers, I said, the longer an index like the S&P 500 lingers at these all-time highs, 3,000, the more likely it will build strength to move yet higher. And again, because there is just such a great many negative concerns out there. Of course, it's the stock market. Anything can happen. So in any one individual instance, could the market move lower? Sure. But the odds say it'll move higher. And I think it's what you're saying as well. Last thoughts and ideas here.
You're right. And again, to just be simplistic, new highs are bullish. That means prices are moving up. We're in an uptrend. So until we're in a downtrend, we're in an uptrend, and that means buy.
You couldn't have put it better. Mike, thank you for joining us and coming on to Market Insight this week.
Thank you, Jeff.
And for all of us here at Sovereign Investor Daily, I'm Jeff Yastine, and we'll see you again next Saturday.